The next move by the Federal Reserve could quietly reshape your portfolio in ways most investors won't see coming until it's too late. Right now, markets are hanging on every word, every signal, and every data point coming out of the Fed. But here's the reality. It's not just about whether rates go up or down. It's about how that decision ripples across stocks, bonds, real estate, and even cash sitting in your bank account. For the past few years, the Federal Reserve has been aggressively raising interest rates to combat inflation. Higher rates made borrowing more expensive, slowed down economic activity, and forced investors to rethink where they put their money. Growth stocks, especially in tech, felt the pressure. Meanwhile, safer assets like bonds started looking attractive again after years of near-zero yields. Now, we're at a turning point. Inflation has cooled compared to its peak, but it hasn't disappeared. Economic growth is slowing, but it hasn't collapsed. This puts the Fed in a difficult position. Should they continue to hold rates high? Should they cut to stimulate growth? Or should they wait and risk being too late? Each of these scenarios carries massive implications for your portfolio. If the Fed decides to keep rates higher for longer, expect continued pressure on high-growth stocks. Companies that rely on cheap borrowing will struggle, and valuations could compress further. On the flip side, sectors like financials and energy may hold up better. Bonds, especially short-term ones, will continue offering decent yields, making them a safer parking spot for capital. But if the Fed signals rate cuts, everything changes. Lower rates tend to boost stock markets, especially growth sectors like technology and innovation. Suddenly, future earnings become more valuable again, and investors start taking on more risk. This is when you often see strong rallies, but also increased volatility. There's also a third possibility the market is underestimating: the Fed waiting too long to act. If economic data weakens faster than expected and the Fed delays cuts, markets could react sharply. This scenario could trigger a sudden correction where both stocks and risk assets fall at the same time. So what does this mean for you as an investor? First, diversification becomes more important than ever. When uncertainty is high, putting all your money into one sector or asset class becomes risky. A balanced mix of equities, bonds, and even some cash can help protect your portfolio against unexpected moves.